You're live.
Start. Good to go. Hi, good afternoon, everybody. Thank you for joining in today. And it's my pleasure to interact with you and engage with you in very, very interesting equity markets. It's very normal in very normal markets. You don't get the advantage of focusing on so many issues which you can focus on in the current environment, which allows you to actually really discuss threadbare what are the specific actions, steps to be taken to take advantage of current markets. I see markets in two contexts. First, primarily, is that when you have significantly a lot of bad news in terms of what is being reported in the press or the negative news which has been coming out now for nearly 6 months in terms of economic growth, all this makes equities far more reasonably priced because there is no euphoria. There is no People are not jumping over one another to buy equities as they used to do in 2017 or in 2007 or at various points of time. So today you are getting companies and businesses at uh, reasonable prices post the correction which has happened. And it is very interesting that perhaps some of the best times have come in India to accumulate, create portfolios, and understand and evaluate, invest, and create portfolios for the next 3 to 5 years. I just want to emphasize on one or two important things. First is after 4 or 5 important reforms which have happened in India in the last 5 6 years, and after so much of effort which has gone into doing the most difficult things to do, I think we are now possibly in front of us are the next 3 4 5 years we will actually reap the benefit of these 4 5 developments. All of you know all of that: GST, bankruptcy code, uh, the reforms related to real estate, all these factors and the corporate tax rate cuts have been milestone reforms which will benefit investors from the longer period of time. See, these are the reforms which India has been waiting for 15 years. So when you implement them, you definitely have one or two difficult years, and which is what we have seen. Another interesting point I just want to bring about is when people look at portfolios and look at what kind of allocation they want to do in mutual funds and how they go about doing it, I think the rule should be very, very simple. Please understand, timing the market very regularly on a monthly, 2 monthly basis is prone to much higher risk because you can imagine the fund manager himself is investing and timing the market, then the person who's distributing is doing it, and then the investor himself is timing it. So you can't get all the three actions right at all points of time, and hence you have to take an approach where you do annual adjustments to your portfolios to balance with the end goal of meeting what is your end objective with the money you have put into investment. So let me simplify this in 2 3 context and explain it to you. In India, nearly 70% of the total market is large cap because the top 100 companies generate 70 80% of India's profits, and they have survived the most difficult environments, and they are actually growing in this whole phase. So large cap should be a main core important part of your portfolio through cycles. You can choose based on your risk profile a 50% weight in a large cap mutual fund versus a 70% weight in large cap mutual fund, depending on what kind of a profile or what kind of a risk or time frame you're looking at investing. But at over cycles, you need to own at least a definite 30, 40, 50 percentage of large cap portfolios because that gives you the stability and ability to move across cycles. Second is come to the other piece of the mid cap and the small cap portfolios. The mid cap and small cap combined are 30 35% of India's market. They are companies which are young, they're growing relatively faster on an average, and some of these will eventually become large caps over a period of time. Not participating in this segment because the conditions are bad or because their prices have corrected is also a risk. So you should actually participate in this category as well. And in your risk profile, you can choose broadly about between 30 to 50% in these spaces, depending on what is your risk profile. Please understand equity investments and mutual fund investments are at least from a 3 to 5 year horizon. And more importantly, the best thing would be if you can tie up these investments from a end goal point of view, which is like about 7, 10 years later for a specific purpose you're trying to invest, and then review it every year or every 2 years, whether it is in line to meet with the objective, I think should be a much better approach. This question of balancing your mutual fund portfolios is a very important strategy, and I'm trying to take you through the equity side as a base because this is where you need a lot of adjustments which need to happen over cycles. In 2017, when we had a very strong mid cap and small cap rally, and where large caps were underperforming, mid caps as a category and small caps as a category are trading, we're trading at a much higher price than the large cap space. Now, these kind of phases allow for some adjustments in your portfolio where you can periodically shift 10-20% of your investments from large to mid or mid to large. But please don't make it a one sided portfolio because you think you're positive on the markets. Because predicting markets on a 1 to 1.5 year, 2 year basis is generally your probability of getting right is not more than 50% because that actually creates a lot of decisions. That's why people say mutual fund investors have made less money by the mutual funds itself because of timing changes which keep on happening at various points of time, and because of the news flows which keep coming at every point of time which says there is a that this kind of a crisis is there, that kind of a crisis there. Please understand, this is my 25 years into investing. I've seen n number of crises, and people tend to keep shifting for crisis from crisis to crisis every 3 months, 6 months, 12 months. Only way to handle this volatility is to have a base portfolio of stable businesses, and on top of it have a combination of 30 to 50% mid and small cap businesses when they are in favor in terms of your valuations, not when there is a momentum in those categories. So today in India there is no big momentum in any category except a select set of stocks. So today investing into equities and carrying a reasonable mix of large and mid cap at maybe 50-50 proportion could well be a very good balanced portfolio from a 1 to 3 year horizon, because all the three categories are reasonably or rationally priced. If an investor is a little more risk taker, he can have a better allocation toward mid and small cap space. But on an average, to meet your end goals of getting market returns, market plus returns over a period of time, it is important that you allocate. You don't keep extreme allocations and don't try to time the market. Please spend more time in the market to actually maximize your returns. Now, most people generally, when they invest, they look at the last 5 years as an important criteria to choose which category they would go about investing in. Please understand that the past which has happened, say what's happened in the last 5 years, there's a much higher probability that the next 5 years generally will be very different from what has been delivered. Our approach in this environment is to choose based on judgment that over the next 3 to 5 years what categories can reasonably deliver based on where the valuation stand, because that is the only thing you can really judge. And you cannot judge madness of crowds, you cannot judge global changes, you cannot easily judge a bull market, you cannot easily judge a bear market. But what you can do is with your asset allocation and balancing portfolios, you can actually ride through all cycles. So please choose mutual funds as a category for not maximizing returns, for optimizing returns over a period of time and reaching your end desired goal. See, it's most important to reach an end desired goal than it is important to being right every 3 months or every 6 months. So it's like somebody is traveling from say Bombay to Pune, right? So you can go, it's a 200-kilometer distance. You can drive at 50 kilometers an hour, you can drive at 100 kilometers an hour, you can drive at 200 kilometers an hour. If you drive at 50 kilometers an hour, it takes you 4 hours to reach. Drive at 100, it takes you 2 hours to reach. But if you drive at 200, you may or may not reach. So we don't want that objective to happen. And this will allow you, and hence, if you do asset allocation or if you do allocation within the asset classes, especially referring to the equity piece in that manner, you can actually ride through all cycles. For example, if investors were, instead of being overweight in mid and small caps in 2017 end, if they were having a higher proportion of weight in large caps, they would have done beautifully well in the worst bull market or a very bad worst bear market or a very bad market, which has been the case in the last 2 years in generally mid and small cap stocks. Once these corrections have happened, a large part of corrections have happened now, it gives you another opportunity to participate in mid and small cap space where allocations could be increased. But please don't do it on a very short term basis. At least have a 1 to 3 horizon, even for shift in allocations. And please look at valuations as an important uh, threshold, which generally mutual fund companies and various analysts communicate to you as important guidances towards it. And please carry a mix always. Don't make it like a portfolio which is uh, uh, kind of on one side of extreme. So please don't make it 100% large cap or 100% small cap or a mid cap portfolio, because it's more important to stay through the journey to reach the destination than actually if you are forced to get out in the middle for some accident which might happen in one specific category. From a market point of view and from a business case point of view, as I mentioned at the start, 5 7 very important reforms have happened. We think investing from a investing from a all those reforms have also impacted our growth, right? And because these reforms have happened and they have impacted our growth, you have seen markets underperforming. So you have got about 4 5 years of 5 6% return in Indian equity markets. On top of it, you have now had an impact of coronavirus coming in for global news flows relating to that, which is an event which is difficult to predict broadly. But I think generally it is one event which is also giving you valuations which are far more attractive. So it is a case of bad news coming in and giving you good prices to invest from a time frame point of view. We think we have seen these crises earlier. Everything may not be exactly same, but when prices are in your favor and you have a time on your side, I think some of these negative challenges or some of this volatility which is coming about is actually you can use it as a friend to create portfolios rather than worrying about it as a problem. In fact, you should welcome volatility and worrying about it. And I think these kind of events only which are large in nature or which have some impact give you a chance of buying the same businesses which you thought were good for the next 50 years or 30 years at very reasonable sensible prices. uh, to your another view or another question which is generally on what is the right time to balance, right? Please understand, review it periodically, once in a year, once in 1.5 years, or once in 2 years, where you have extreme euphoria. When a lot of newspapers talk about the next bull run in a mid cap, or they talk about very specifically disproportionate positive things about one specific category, please understand when media comes to know about what's happening, I think that story is more ending towards it because it's already fed into retail, fed into everywhere. Please don't follow the hype and the euphoria which is there in each of these categories. And whenever you find there is hype and euphoria, please reduce allocation to those areas. So generally, we say which are the most hated categories today where a lot of people don't want to buy. That is why you are getting cheap prices. So getting these cheap prices is a function of discounts which happen in the market. Either they may happen because of coronavirus issue, either they may happen because of NBFC problem, either they may have of some issues like that. But I think over periods of time, because India is a growth economy with very young businesses, I think we have a long journey to go. You use a 1 to 3 year kind of an horizon where you keep allocating so that but keep a core portfolio in the large cap category always, because that allows you to really maneuver, really handle the volatility. As I said, it is more important to reach the destination than being happy in the first 1 hour of the journey. So I think please take the example from Bombay to Pune as a example reflecting that it's most important to reach your destination than actually trying to be right every day, every month, and every week. The specific to the question relating to generally thoughts in terms of how long this problem can be there, I think ideally, given where science is, given where developments have happened, and given where there is conscious effort from every country to handle this isolated and solve the issues which are relating to the recent developments on the coronavirus side, I think it does not. It is unlikely that it will long laster because there is also life cycle. There is also uh, time frame. There is also weather conditions which matter, and there is a concerted effort by global governments to solve this issue. We think uh, Please treat them as generally issues which may last temporarily for a few months or thereabouts. But I think gradually the issues will be much, much, much irrelevant. See, for example, 3 months back, the biggest worry was China US trade war. 3 months before that, the biggest worry was relating to election results, which way it would go. 3 months prior to that, the biggest worry was what would happen after NBFC crisis. See, so we have shifted from problem to problem. So just stay focused on your end goal objective, and whenever you get bad news, in most cases, you have a high probability to get very good prices for the companies and the portfolios and the mutual fund portfolios you're looking at investing in. Uh, Also, there are thoughts on ESG strategy, which I just want to emphasize on, which is uh, just want to emphasize on, and ESG as a strategy internationally has become very big. Developed countries which have already seen their journey and have seen the development and have seen the investment in old economy and resources and all that, and have met their needs on per capita incomes of power, per capita national security incomes in several oil and various other areas, have already started to shift towards newer energy and areas which are less harmful to the environment, are more favorable to social side of it, and also are more companies and businesses which are more oriented to running funds which are or running businesses which are in a sustainable, good governance manner. So our cases, the environment, social, and governance factors are relevant. We already use the governance factors to a large degree in all our investment for the last 20 years. So it's actually the same thing is continuing there. Some more emphasis on environment and social factors. It's certainly the need of the hour, and it is becoming important over a period of time. And we need to know over the next few years whether a ESG kind of a strategy works better than a normal strategy is yet to be proven in Indian markets because it is very young. Internationally, it has run the course. It is already seen to be gaining momentum, but we will have to evaluate from an Indian context because we are still at 1,800 $2,000 per capita incomes versus most developed countries which are closely following ESG strategies are at 30, 40, $50,000 per capita income. The In terms of strategies of using index funds versus using funds which are actively managed, both have different advantages and different strategies. This battle of indexing versus investing has been there globally. So people are looking at indexing as a strategy, investing as a strategy. Please understand, in India, many sectors are just being born. It is something like ESG, how it has already evolved somewhere else, is just beginning to happen here. Likewise, there are many such categories and sectors in India which are just being born. We virtually don't have internet companies in India. We virtually insurance just got listed 3 4 years back in India as a category. Mutual funds have just listed in the last 1.5 2 years in India. So many new sectors are continuously coming in. They generally are outside the index till they generate a huge amount of value, and then they come into and become a part of the index over a period of time. Second is this kind of an opportunity, even in all segments of the market, exists. Hence, the ability to create alpha definitely exists in many categories in India, and hence, active investing is also a very valid option in a market like India for the next 10 15 years. Index investing is a starting point, and if somebody wants to participate in an index, that is also a good strategy. But a single 1% difference compounding over a 10-year period can make a huge difference to the wealth an investor can accumulate. So if you have a longer term time frame, have focus on have right investments in funds, you may end up with materially differentiated alpha. So if somebody ends up with a 1% higher alpha over a period of time, the amount of incremental value which is created in a portfolio over 5 10 year period because of the compounding effect is generally way higher. So please check the differences which are there if somebody does 1% 3% alpha compounding over a 10 15 year period, and what the index would deliver and what those funds can deliver. And if you are able to reasonably spot around that area and end up with differentiated returns over a period of time, it might be a useful case to continue or adding to your active investing portfolios. Uh, from a tax saving angle, this budget has come out with a very interesting thought. They have said we will allow people to choose where they want to save, how they want to save, by not directing them to put money only in these specific areas. But please understand, most people who are investing at least should have a 3 to 5 year horizon. Hence, tax saving funds are a very good start for people who are coming into the market for the first time. Second is allocating money in early stages, because a lot of people who take these tax exemptions are generally in their first 5, 10 years of uh, uh, business, or first 5, 10 years of employment. I think the earlier you put money into equities, the bigger the possibility that you can handle the volatility and actually end up generating long-term returns, because equities as a class do have the potential for compounding a bit more than most asset classes over a period of time. So the emphasis should be tax saving funds generally have a 3 year lock in, but they do give you still an advantage of tax savings there. And uh, given that they would generally be one of the first entry products from a investor coming into equities, and generally if he stays for a 3 5 year period, experiences normally should generally be way better than where they stand today. So this is actually a good case from a point of view of uh, investing in tax saving funds and choosing to participate in these products from a 3 to 5 year horizon, especially when you are an investor who can get a benefit of it as well. Plus, also the fact that the longer term horizon allows you to stick to your equity strategy and equity objective. Also, I would want to emphasize on yeah. Also, I would want to emphasize on an important development which has happened in the last 6 months at our end. Nippon Life, which is the largest insurance company in Japan, and which is the sixth or seventh largest insurance business across the world, has increased the stake in the asset management company of ours to 75%. And as you all know, we are a listed business with 75% now owned by a leading Japanese player. Our emphasis, as you all know, has been towards long term wealth creation, and this transition to Nippon allows you to continue the same tradition. Nippon Life has been our partner for the last 7 years, and through the coordinated effort only we have grown during this period, and we see this opportunity to allow us to become globally competent, best in class globally in terms of what we do, and take our existing processes and effort to the next level to service our investors. A lot of Japanese businesses generally think from not from 5 or 10 year, but 20, 30, 40 year kind of a horizon. And it is very important in investing to have partners and philosophies of partners matching the longer term horizon. And I think there is a significant value add the 130 years of experience of Nippon Life would bring to it. And hence we have transitioned to uh, our name has transitioned from Reliance Mutual Fund to Nippon Life Asset Management and Nippon India Mutual Fund recently. So it's the same core team running the whole asset management business. Plus, you're getting value addition from the processes, the global capabilities, and the technology and the network globally, which will allow us to participate in many categories, allow us to expand our product baskets, allow us to service our customers better, and take care of our investors from a 5, 10, 15, 20 year horizon. So I think it is a positive development from all investors' point of view, and it presents an important opportunity. And this is one of the largest single investments in by a Japanese company in India. It would easily be among the top three, four investments in India by a Japanese business, especially with this kind of scale and commitment. Yeah. Very interesting question which has been raised is also on the fact that how do you differentiate and select funds? Please understand, funds like any other specific products have their own cycles. So they go through their cycles, they have their whole thing. What you just have to see is there are three criteria which really count in my reading. What is the longevity of the asset management company who's been running that product? How important that product is for the asset management business? Second most important thing to know is who's the fund manager and the asset manager running this product, and has he seen cycles? Please understand, every 2 years, every 1 year, markets will be different. So, and cycles can change, but has somebody experienced all sorts of cycles, or is it people are getting first time lucky? And given that this, so the longevity of the asset management business itself, because they have to be there to service you, they have to take care of your requirements, plus they have to take care of investments in research, investment in fund management, investment in resources, and continuously improve our ability. Second is investment. Second is the key fund management personnel who are running the product and who are managing it. What is the track record over a 10, 15, 20-year period? Because that is how now you are lucky to have 10, 15, 20-year track records also in a lot of products. And hence, these two would be very important criteria which will allow you to choose a product. And interestingly, to the question which is there is coming from tax saving funds. Like I mentioned at the start of in the middle of the conversation on the opportunity in tax saving funds, it certainly is the first port of call for generally investors who want to save taxes as also take advantage of equity risk. Given that it has a 3-year lock-in, it is a positive thing from a point of view of any investor coming in, because markets can move up and down. They have their own journey and volatility. But if you have ability to lock in money from a 3-year period, and that I think is a phenomenal advantage to any investor, especially when he's starting and tasting equities, because somebody who has tasted equities over a 10, 15-year period might understand long-term investing. But the tax saving fund as a category itself allows you tax benefit, as also gives you a 3-year lock-in, which allows you to stay invested at least for that period of time. In most cases, if you make money in short term, at least in equity market, it is more luck than skill. The longer you stay, the probability and odds of you delivering or achieving returns over a period of time in equity markets increases. That has been an experience in the last 25 years, and this is what we would want you to look into and focus on that. To the questions between how one can choose between what are the risk profiles of different products, please understand each category will have a different risk profile. Large cap, mid cap, small cap will have a different risk profile. Risk in financial terms is defined as the volatility in the returns. So how different are the returns from at specific points of time, and how much more variable they are. Real risk is what is your risk of losing money by investing in equities from a 3-year, 5-year horizon. I think if you segregate these two risks and understand, if your allocation to equity is right, you are not leveraging, taking loans and putting money into equity, but putting money in equity as a part of a long-term saving plan. Equities offer a tremendous value. So the real risk actually reduces dramatically. To choose specific funds, one way to reduce risk is how much you own in large cap, how much you own in mid cap, and how much you own in small cap. Don't let this go beyond the range. Keep it within a band in each category so that you are not fooled by randomness of markets at various points of time. From a specific category of which particular funds are generally beneficial, primarily choose for investors who have been in the first 3 to 5 years in the market. Primarily choose diversified mid cap strategies from a 3 to 5 year at least investment horizon or more. And please focus on the products which have at least a 10, 15-year track record, because they would have seasoned and seen these cycles. In terms of the systematic investment plans, and how to uh, work towards systematic withdrawal plans also, I think these are very interesting, very useful products from a point of view of accumulating a lot of units. And second, the systematic withdrawal plans are very useful add-ons to the products which will allow you to at different points of time meet your requirements of cash flows. So interestingly, in India, more than 2.5 crore people today do SIPs, invest on an average 3 to 4 thousand rupees a month, and a lot of people have signed up for 5 years, 10 years, 15 years to do it. Good part is the SIPs take away the fear of markets. Once you're doing that, you don't need to look at markets daily. You don't need to look at markets 3 monthly. You just need to follow that course over a period of 3, 5, 10, 15 years, which allows you to compound, buy more units. If markets go down, you actually end up buying more. It is really the investor behavior of putting money when prices are in your favor or valuations are in your favor that gives you returns. And that behavioral aspect is taken care by SIP investing. The similar The mirror of it is SWP, or systematic withdrawal plans. See, when people accumulate money over a period of time, they need money on a monthly basis or quarterly basis to meet some requirements. So, a small percentage on a particular amount of percentage from that capital can be systematically withdrawn without trying to time the market. And there are simple automated solutions available for you to do that. So, anybody can do a systematic withdrawal plan on their existing portfolio and keep meeting their requirements of cash flows over a period of time. But please understand, you have to first accumulate to redeem. So please focus on creating larger size portfolios or larger investments for long periods of time. And then as you reach a requirement where an X amount of money is needed every month or every 3 months, you can get into systematic withdrawal plans. Systematic withdrawal plans are also now very tax efficient versus dividend distribution plans, which are post the budget development which has happened. On the case of the opportunity, on the case of the question whether the size of the fund affects the growth of the fund, especially the small cap category, see, generally, uh, you have to see that there are many variables which can impact a fund, right? Uh, in the case of large cap category, generally size is of no relevance, in the sense it's not necessarily the most deciding factor. In the case of mid cap, size has some relevance, but it is still not the most deciding factor. In the case of small cap, size does have some relevance because there, but finally the ability of the fund manager also is needed. See, some fund which has grown from a smaller size to become a large size, the fund managers running them is also seasoned, seen through cycles and all that, and they can navigate through it. So your question points towards maximizing returns at all points of time. It is most important to reach your destination, and hence it is more important to see risk adjusted returns in each category rather than one time returns of small size funds which might come at some point of time and may not come at a lot of periods of time. So it's more the sustainability of returns of funds which count. Size is not a material factor in large, and also in a lot of cases in mid cap side. It is somewhat a little bit important in the small cap spaces. But I think on an average, if you're invested for a period of time and you're not timing every 3 months or 6 months in mutual fund investment, which is actually a negative factor, you can actually end up without size doesn't become the most important factor in your decision. It's the quality of the fund management team, it is the pedigree of the asset management company, and the capability of the combined team to service customer requirements and guide them through the cycle. On specific areas, the question relating to what kind of money one should invest in a mutual fund and what is the minimum amount. See, it's a you can start investing in a mutual fund with a very small amount as well. But please understand, do a simple asset allocation of yourself of how much investment money you have today and you can have over the next 3 years, and decide how much of money you don't need it for 3 years as a starting point. Right? If you start small, investing 100 rupees, 200 rupees, or 500 rupees, it may not necessarily end up meeting the goal which you really want to meet. But it is a good start to do it because you get used to the product, understand variability, understand the lot of learning goes into that. But I think directionally you should link it to your goal, and what amount of money you can invest is the amount of money you think you can take some challenges with. Can you lose 10% of it? Can you lose 15% of it? Can you accumulate over a point of time? And do you have at least a 3 to 5 year horizon when you're looking at investing in a mutual fund space? So this decides. So there is no minimum amount, in the sense there is a very small ticket, anybody can invest that much of an amount. But our case is, please invest to an extent which is relevant to meeting your objectives, your financial freedom, your financial goals in the longer term. And the small tickets which are offered in a lot of these areas are offered for people to try and test the product and then actually use it as a part of the investment, their investment planning. There are mutual funds are established now, very well regulated, 20, 25, 30 years into existence, and have demonstrated track records over the years. We do carry equity risk because equity markets go up and down. You carry equity risk, but please understand, we as a country are a very young country. uh, growing country, huge potential. Stocks generally tend to, some stocks may not deliver at different points of time, but generally you in mutual funds you carry portfolios of stocks of a lot of these companies from a longer term horizon. And a lot of these good businesses keep on growing in India because in every category we are young. And when portfolios choose these companies and sit with them for a period of time, you automatically get a benefit. So a mutual fund, so the myths which say you can lose all the money in a mutual fund and uh, uh, the challenges which will come about, it generally doesn't happen unless you are only in one category and unless you are come at the peak of the cycle. You end up losing 20%, 25%, 30%, which keeps on happening. But if you come in a systematic manner and you are not carried by the euphoria in the market, I think these are very interesting long-term products which can offer value to everybody and meet your retirement goals. An update on the small cap category and Nippon Small Cap Fund. Interestingly, this segment has been impacted in the last 2 years because of the non-banking financial services slowdown which we have seen, and also the fact that in 2017 you had a big euphoric run in the small cap and the mid cap space. We think valuations, because of all the pain and because of further impact which has come about from the coronavirus issue, have now materially corrected, and valuations in this space have become attractive. Please understand, small cap generally within investing is a much longer term tenure product, and also it has to be a part of your portfolio, not everything of your portfolio, not the whole of the portfolio. So if you allocate it reasonably well, I think the long-term outlook for the small cap category is also good, because, like I said, in India, many companies are emerging, many businesses are still very young, and many businesses are still very small. So I think you have an opportunity, because the current large caps today were definitely small and mid cap businesses 10, 15, 20 years back. So that opportunity is there in front of you to capture. But please play with allocations, because generally small cap investments have cycles which are longer, have variability or challenges of upside and downside, which are much, much more in other categories. On the debt side, the debt itself is a separate and an important asset class within mutual funds. So I talked to you about equity. Now let me take you through a little bit on the opportunity on the debt side. See, you've got lot of savings of people, and all that money cannot come into equities, because a lot of people need money for shorter term requirements. A lot of people need money for near term requirements. A lot of people don't want variability, so they want a balance between returns as well as availability of liquidity. Debt plays this role, and debt has a and debt, there are various types of products. There are simple products which give you the desired return, or return objectives can be met. Second is they give you specific you can participate in the interest rate cycles if you're an evolved investor, but directionally they give you a longevity, they give you returns which are competitive within the competing universe, and they also have several tax advantages versus existing categories. So debt funds do have their own role to play. Please use it as a part of your overall allocation. First, I talked to you about equity, now debt. So please use it as a part of your overall allocation in the investment. And they also have an ability to, kind of balance your returns versus the volatility of equity. So if you're a risk-taking investor and you can have a larger proportion of equity, that is welcome. But you need to understand that debt adds a lot of value in terms of meeting your requirements of cash flows at all points of time, and you can use them to meet your specific objectives. Our Nippon debt funds are focused on each of these categories: short term, medium term, long term, with defined portfolios and defined risk profiles for those specific categories. And we think the opportunity there is as big or larger, given there is so much of investment and so much of savings which are there in India, and which continue to grow with the broad growth of GDP in the country. On the interestingly, funds are for all investors, and it's where it's specifically to meet an end objective or an end goal. So investors, whether the person is a housewife, whether uh, she's a lady, whether she is a child, whether he's a child, whether it's actually specific to the goals which are there. A housewife can invest and save for retirement because they don't have a housewife may not have a retirement or a pension plan coming about or savings available for their old age. They can choose specific savings on a monthly basis to create a portfolio over a 10, 15, 20-year period to have a participation or end up having a corpus for retirement. Whereas people in jobs and people who are working may have some retirement, PF, or pension option, pension plans. So I think one important need is to create a buffer through cycles, plus create a buffer for retirement for housewives, which they can use when they reach or they can withdraw when they require it over a long period of time, and they can supplement the objective of not having retirement plans, which generally a working individual in India has the luxury of having. Second is uh, it is important to choose products depending on your time frame and depending on the kind of risk you can take. For example, if you are unwilling to take a large amount of risk, please focus on the large cap category. Please focus on the uh, category which is more stable than general average markets. And if you can handle volatility and variability, then you can add on to mid cap and small cap portfolios. But since you are over a period of time wanting to reach an end goal, what's the most important thing for any individual, whether it's a housewife or a working woman or a young child or somebody wanting to meet his retirement objectives or somebody wanting to reach his schooling objectives or his education objectives, what is most important is stay through the course, start very early, and just focus on, say, one or two stable categories which can compound over a period of time for you. So I think the large cap is an interesting category, or retirement category is an interesting category for some of these investments. Yeah, it is a very interesting question which comes about that should investors choose the best performance of the last 3 to 5 years? I always said, markets change, and I think it's most important that past performance, and hence it is mentioned that past performance is not necessarily a reflection of the future. The past performance and over a 10-year, 15-year period allows you to understand how the fund manager works in different cycles, how the asset management company focuses on customers over a 10, 15-year period, and it allows you to segregate between short termism and long termism. The longer term track record does matter in evaluating and doing it, but most equity investing, it just tells you that, if somebody has seen or done over a 10, 15-year period a good job of it, the probability of he doing the same over the next 10, 15-year period is higher. There is no certainty, but it is higher than before. It is like you're going with an experienced driver on a highway, or you're going with a driver who's pretty young and who's learning the ropes now. It's not that the other person cannot improve, so there's always an opportunity. But what is most important is you are able to reach the end objective. Hence, choosing the right AMC, the right fund manager, and the longevity of the product they're running is a very, very important criteria in choosing it. And it need not be a top performer. It need not be, it can be a reasonable performer over long periods of time, because compounding actually allows you to gain. In Interestingly, a lot of investors choose a large number of funds in their portfolios. And I understand that if you have a select set of 4 or 5 funds, it is still okay. But if you choose 10, 20 funds, it's become virtually you're owning the market, right? So for investors who are choosing large cap, mid cap, small cap categories, please work with allocations depending on your age. What is the risk? How much of capital you can use if there is a problem? So what kind of volatility you can bear? And given that, like I mentioned, the market is nearly 70% large cap and 30% mid and small cap, use that as a rough threshold over periods of time. So individuals can choose depending on risk profile, 50 to 70% large caps, depending on one valuations and their risk profile, and 50% to 30 to 50% mid and small cap, depending on valuations and the risk profile. To your question relating to Allocations, I think this is one way to approach. Another interesting thing you've talked about is investing in international markets. International markets do provide a diversification, but please understand, uh, they provide a diversification from a currency point of view also, and a set of companies point of view. Hence, performance can be very different from what is in India at different points of time, and can be useful. But please understand that uh, there also your allocations, it's very difficult for you to keep timing multiple markets, and you choose an allocation and leave it for a long period of time, and you have a higher probability of getting reasonable better currency adjusted returns than trying to keep changing allocation based on what you are reading or what you are seeing in the marketplace. uh, so choose categories, and within these categories, in a once in a 2 year period or 1.5 year period, or if extreme markets happen, you can adjust allocations which are there. And like I mentioned, purely the allocations are a function of your risk profile. How long are you willing to keep the money in? If you're willing to keep the money for the next 3 years only, please choose the large cap category. If you're willing to keep money for 5 years, 7 years, you can choose mid and small cap categories in different proportions. And if you need money at any point of time, you need to have some liquid allocations to large cap categories or liquid debt funds to allow you to manage the near term cash flows which are there. Interestingly, when goals are defined very clearly, like one of the questions are relating to those goals, I think it's very simple. You just have to choose what kind of return expectations can come in the marketplace. We have seen, let us take broadly over the last 10, 15, 20 years, people have compounded money at 8%, 12%, 15%, depending on how the economic conditions have been. So if somebody compounds at 8%, he ends up at a particular rate of return or a particular target. Somebody compounds at 15%, he ends up. There is no guarantee which of this will work for you. So you can work at a middle path, review every 3 years whether you are on track to reach your goal or not, and adjust your incremental flows which you are putting in based on your end objective of reaching the specific area. Why this is important is that when you're targeting an X return, so suppose, for example, if you're targeting a return of, in a simplified case, suppose 100 rupees in a 10-year period or a 5-year, 10-year period, if you start off with 25 rupees today and it has to become 100 rupees in 10 years, for example, it's a compounding of about four times totally. So it's a compounding of about 15% a year. I think rationally, that is a very strong level of compounding. And you can just calculate, if you're doing for another 10 years, for 20 years, that 100 will actually, if it compounds at 15%, should become about 400. So a 25 rupee investment becomes a 400 rupee investment in a 20-year period. And to reach, say, in 25 years, another 5 years of compounding will again double the money to 800 rupees. So if 25 rupees is invested, and if it ends up at 15% compounding for 25 years, you can end up with 800 rupees, provided you don't withdraw, you don't redeem at the wrong time, you don't keep on timing. If the markets give you 15%, if they give you 12%, you have to invest more. This 25 has to maybe possibly move up much higher. And if you get higher returns than this, you'll actually be happy at the end, because you will have attained your goal, and you've done it. So please err on the side of conservativeness, assume moderate returns, stick to your goals, and stick to the time frame. This 25 years is more important than just a, just the quantum of money you're putting in. How much percentage of one's savings an investor should put in mutual funds? And the mutual funds are established products with now longer term track records and all that. Mutual funds offer both needs of your fixed income requirements as well as equity market requirements, right? So technically, a person can do all his asset allocation to these two categories, and also possibly choose if they have a benefit on government allocation plans which are there. But primarily, these two categories, we have all the products which a mutual fund can offer, which can service the need of every customer. So whether it is fixed income, whether it is equities, and within fixed income also, products which can take recurring SIPs, which can keep having recurring investments in it, and also have systematic withdrawal plans which allow you to take out money whenever you want from these products. So I think the mutual funds offer the whole basket of products. So to your question, whether how much money should go into mutual funds? See, it's a question of, suppose you save. It's a question of the level of your saving you do. The larger amount of money you can allocate to mutual funds in different categories based on your risk profile is what you can do. Technically, 100% of your savings can also come to mutual fund by design of the products and the categories we offer. And whatever requirement for a tax saving point of view is still there in your category, you can use that much of money to take advantage of the tax plans which exist in various other asset classes. Yeah. So thank you very much. Thank you very much. It was a pleasure interacting with you. Thank you for joining in today. And we have tried to take as many questions as we could. Uh, Mutual fund and mutual fund investing and the ability to just stay invested for long periods of time is a very rewarding experience. And I think given that now you have demonstrated track records of 10, 15, 20 years in a lot of funds, a lot of, and the industry as well has now become established with millions of people investing, I think it is the way to grow over a period of time. Thank you very much for your interest and thank you for joining in today. And it's a pleasure interacting with you all.